Good afternoon, ladies and gentlemen, and welcome to the STM Group Plc presentation for the half year ended 30th of June 2020 and update on prospects. Firstly, apologies for the very slight delay. We just had to refine a few of the technical bits. To start with, if we could cover a couple of housekeeping items before we commence the presentation. We would like to submit the following poll, which you will see on your screens. If you could please answer that, that'd be much appreciated. Throughout this presentation, investors will be on listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Or if anyone has dialed in, you can also send a question via stm@walbrookpr.com. The company may not be in a position to answer every question we receive today. However, the company will review all questions submitted and will publish responses where it's appropriate to do so. These will then be available on the Investor Meet Company dashboard. Finally, we'd like to remind you that this presentation is being recorded. We anticipate that there will be some newcomers to STM, so we are going to take a few minutes at the beginning of the presentation to introduce the business so that everybody's up to speed on STM's objectives. I would now like to hand over to Chief Executive Alan Kentish and Chief Financial Officer Therese Niche. Alan.
Thanks, Tom. Good afternoon, ladies and gentlemen, and thank you for taking the time to come to listen to our presentation. As Tom said, I think probably a good starting point is just to give a little bit of background and history to where STM's come through in terms of its journey. And I think that sets the scene really for today's sort of present day position. STM in one guise or another started off life in 1990 and was based in Gibraltar. It was a traditional trust and company business, similar to the likes of the JTCs of this world, etc., and what goes on in Guernsey and Jersey currently today. And our focus at that time was very much about that international tax planning side of things, and invariably that would result in a family trust or an offshore company as and when people were moving out of the UK and setting up homes, typically in Spain or something like that. If we roll forward to 2007, that's when our life started as a AIM-quoted company. Our vision of the market at the time, possibly a little bit visionary at that time, was that the market was very fragmented, and we saw that the ability to float on AIM, to raise some money by reversing our business in, and then going on a buy and build strategy in the trust and company sector was the way forward. That worked pretty well for about 18 months until we hit really a brick wall in terms of the financial crisis. And as I'm sure most of you will understand, those individuals, in terms of high net worth individuals, where there is times of uncertainty, invariably will sit on their hands and won't actually make decisions. So we saw our revenue in 2010, 2011 really start to dry up in our traditional marketplace. It resulted in us really looking as to how do we diversify what we do. We were based in Gibraltar. At that time, the gaming industry in Gibraltar was really taking off in terms of the betting industry coming over from the UK. And one of the issues they had was that staff would move between gaming companies. And one of the retention rule tools that really came into play was something very straightforward. It was called a pension, which wasn't really something that was offered in Gibraltar previously. And because we were a professional trustee, we ended up becoming the trustees and the administrators of a lot of these pension schemes in relating to the gaming industry in Gib, and we saw the opportunity in Malta as that was developing as well. So we ended up setting up pension businesses in Gib and Malta, and we were doing okay, nothing dramatic, but we could see that what was happening in terms of the Guernsey market was this concept called a QROPS, a qualifying recognised overseas pension scheme. There's a lot of legislation attached to it, but for all intents and purposes, it's the equivalent of an overseas SIP. So it's not a UK regulated product. It's regulated by an alternative market such as Malta or Gibraltar. Guernsey was doing incredibly well on the QROPS market. The product was typically aimed at expats who had a UK pension pot, but for various reasons had moved overseas, and there was no real reason to keep their pension in the UK. We struggled initially to break into that market, but for one or two fortunate scenarios, primarily about the way that Guernsey was transacting business, that it allowed us, as little old STM, to get a decent foothold with a number of the financial advisors throughout the world that were currently offering cure opts as products. And that's really where our success started, really, in terms of the pensions business. And we very quickly, we grew from minimal amounts of volume, and probably 2 men and a dog in Malta and 2 men and a dog in our Gibraltar pensions business, through to around about 10,000 expat pension members, because they're not necessarily pensioners, they could be below pension age. So we started to pick up a lot of business from the intermediaries. And that's really became our successful drive and our focus in terms of growing that. We had a complementary life assurance business, which offered a slightly different product, but again, it was aimed at the expatriate market. And that sort of brought us through to around 2016, very solid growth. The trust and company business was holding its own, but it was becoming quite difficult to grow, really. During 2016, we saw the opportunity to buy something in the UK. So in 2016, we bought London Colonial. And there was a rationale behind that, was that we were very much, from a market perspective, from the stock market perspective, we were seen as like the overseas guys. You're the offshore guys, you deal with expats. And we felt that it would be beneficial from a rating perspective, and also complementary to our products, to become more UK centric. And that opportunity arose when we acquired the London Colonial business. So we bought a UK SIP business, London Colonial Services. It actually did come with another Gibraltar life assurance company. So that ended up with us giving us another revenue stream in terms of our Gibraltar business. And from there, we carried on growing in terms of the expat market. We've offered some products to the UK market, but primarily in terms of the UK SIP, we were offering a slightly alternative product to the cure opts, which was what we would call an international SIP. So this became now a UK regulated product. And we've had steady growth during that time. In 2000, what we did have in terms of the London Colonial, in terms of the UK market, it was about a break-even business. In 2019, we completed on the acquisition of the Carey pensions business, and that gave us a much more solid foothold into the UK pensions market. So we've now got, in effect, two SIP businesses in terms of the UK market. The nice thing with Carey is it also came with an auto-enrolment business. And this becomes a bit of a differentiator from us compared to, say, some of the other SIP providers in the market. So workplace pensions, as I'm sure people know, started in 2012. It's been staged in terms of depending on the size of the employers, as to how auto-enrolment would take off. A little snapshot, slightly aside, is that I see that whatever happened in the Australian market in terms of the superannuation market some 15 years ago, which is now a $1 trillion industry, is what's going to happen to the auto-enrolment business in terms of the UK side of things. So it's an exciting sector in its own right. But it does give us then that stronger foothold in terms of that UK market. As of today, how would I describe us? Well, we're pretty risk averse as a group. We don't take investment risk. We don't take underwriting risk on mortality business in our life business. Basically, we administer client assets, and we do that via a number of different vehicles. We've got the starting point in all our journey was the trust and company business, traditional family assets and held in family trusts, etc. As you can see, in terms of the yellowy coloured thing, that's really become our legacy business. It's an area that we don't believe is core or strategic to us going forward. It set us on our journey, but it's become a different type of profile given the attitudes of governments in terms of tax planning, etc. What we do have, though, in terms of the other wrappers, is our pensions wrappers, and these fall into two or three categories. We've got our recognised pension schemes, the cure ops side of things, the Malta and the Gibraltar businesses, absolutely traditional, solid, recurring revenue earnings, minimal attrition rates. Interestingly, attrition rates in the cure ops business side of things is less than the UK market in terms of the SIP market. And actually that makes sense when you think about it, because if you're living, for instance, in Thailand or France, are you really going to take all of your UK pension monies and bring it into a foreign country? You're probably not. You're probably going to just draw down as and when you need it, rather than possibly using the flexi access legislation in the UK. So we have the cure op side of things, and Therese will talk about the volumes and the divisional split and that. We've got our UK SIP products. Again, traditional UK SIP products. We try and differentiate ourselves. We're never going to go head to head with the likes of the James Hay, AJ Bells of this world, who are traditional platform SIPs. They do it incredibly well. They operate in a high multiple, and their investment in technology puts them into a different position in terms of what they offer individuals. Our SIP offering is more bespoke. It's more looking at other investments such as commercial property, etc., which don't necessarily fit within that platform type approach. We've also got, as I mentioned earlier, our UK workplace pension solution. That is a growing area. You can see currently we've got just under 140,000 members. So clearly this is a low value, high volume play. It's a complementary product to our other pensions business, and absolutely is a differentiator from the traditional SIP businesses that are out there. And then finally, we have our life insurance wrappers, which again is a number of different products. I mentioned that they're complementary to the pension side of things, and then they're invariably some form of savings product, the traditional portfolio bond type product that RL360 or Hansard would offer. We also have a slightly more unique flexible annuity product, which is again is an annuity because it pays something on an annual basis rather than it being on that mortality based product. So we're more or less up to date now. I think where our focus is as we currently stand is we've got a number of different pillars as part of our approach to growth. Clearly, we've got a very significant range, a very significant portfolio of products because we offer something to the expat. Again, a differentiator to the typical SIP market, who would clearly only deal with UK residents. We also deal with UK residents. So we've got a large range of products, and it's about offering different products to someone's position depending where they are in their own life cycle in terms of that starting out. So they're getting their first job, they're going into auto enrolment, through to someone retiring or looking at that flexible annuity product as they get towards the end of their life and that pensionable age. So we've got that in terms of our tool bag, if you like. We've got a number of new products that we're looking at in terms of the international pensions side of things. Again, that complements our personal pension, our expat personal pension. And we're looking at some niche products such as the Sharia compliant products, which I'll come back to. Another area that we've looked at, so that's very much our sort of organic growth. Everyone should have plans for organic growth. There's nothing fantastic about that. As a board, we definitely see that there is opportunities for further acquisitions. You probably would have noticed that we acquired a business in August called Barclay Burke. There's a slide on that, and I'll cover that off in a bit more detail shortly. And I guess the final bit really in terms of our margins. Our margins at the moment are not as high as where I'd like them to be. And when we look at some of our peers, their margins are significantly higher. We've got a number of initiatives that are currently in play, which come through in really 2021, which will really start to change that level of margin that we are currently creating. And it's primarily driven by the IT side of things within our business. So we'll come back to, again, just touching on that a bit later on. Finally, and I think I've probably mentioned all these jurisdictions in one way or another, the range of our products, as you can see on the right-hand side, predominantly is carried out between the UK, Gibraltar and Malta. Jersey is our trust and company business. It's a business that we bought, 3 businesses we bought in 2010, 11 and 12. Again, that's the trust and company side of things and is less strategic to us, shall I say. So I'll pass over now to Therese, just to give you some flesh in terms of the actual numbers.
Thank you, Alan. So in terms of the performance for the first 6 months of this year, it certainly does not reflect the hard work that has gone sort of behind the scenes in terms of, as Alan was explaining, working on our products, working on our IT projects, obviously coping with COVID, completely unprecedented year for us. What it has demonstrated is the robustness of our business model, in that our revenue has remained very stable when we compare it to last year, marginal increase in terms of our underlying performance. Historically, we've had a number of accounting adjustments in our accounts. That's as a result of the fact that we've been making acquisitions, and therefore we've had to change accounting policies on those targets, on those new subsidiaries, and a number of other sort of one-off adjustments that don't form part of the regular operations of the business. And therefore, in order for stakeholders to understand the actual underlying business, we thought it appropriate to strip those out. But there's minimal adjustments in this year's numbers, and therefore sort of underlying profitability matching very much the reported profits. It needs to be noted that clearly our margins, as Alan was saying earlier, lower this year than they were last year, and certainly not at the level that we would like them to be, or indeed expect them to continue. The reason for those decreases in profit and margins is as a result of increased costs from last year, and that's mainly as a result of our PII premium, which increased significantly at the last renewal in September, and that's not STM specific. That was as a result of changes in the insurance market and premiums increasing. What is positive to take from these numbers, aside from the robustness of our revenue, is the fact that our recurring revenue continues to grow and underpin the results. So most of our fees are fixed fees, so they're not reliant on AUA, and that was reflected on the sort of the impact that COVID-19 and the downturn in markets and the decrease in the base rate had on our business. Minimal impact on our financials. So our recurring revenue is now up to 10 million, and therefore 85% of our total revenues. We continue to pay dividend. We've declared an interim dividend of 0.55p, which again demonstrates the board's confidence in that recurring revenue and the robustness of our business model. In terms of our cash and cash equivalents, cash flow from operating activities is typically equal profits, therefore very much a cash generative business, with net cash balances of 17.6 million. Clearly, as most of you are aware, we do have, most of our subsidiaries are regulated entities across the various jurisdictions, and therefore a proportion of that amount is required for regulatory purposes.
In terms of the operational side of things, in terms of the first 6 months of 2020, probably the best description is they're unremarkable, despite all of the turmoil that's gone on given COVID-19 virus. And I think if you peel that away, it's exactly as Therese says. Why are they unremarkable? Well, certainly our recurring revenue held up well. There'd be no reason that it wouldn't hold up well. On the basis, it's not driven by AUM. This is fees per client, so they're a fixed fee structure basis. So again, that underpinned our result for the first 6 months. The cost base didn't change dramatically. We moved pretty seamlessly through to working from home. There's minimal impact on our service levels. So again, that sort of ticks the right box in terms of that side of things. The area that did suffer in terms of our expectations for the first half is the new business side of things. And that's frustrating. We can see that particularly there's two products, really. It's the flexible annuity and bulk transfers for our workplace pension. Flexible annuities, what we've seen, it's a relatively new product in terms of the market, so we're still working with only a small number of IFAs on this product. We've seen the pipeline grow significantly. I've used the word eye-wateringly in some presentations. However, the delay in converting that to applications is frustrating, and I do put that down to COVID. What we've seen is that the IFAs, as you'd expect, have found new ways to interact with their clients. So they're having electronic meetings, they're talking about products, including our products, and they're engaging with their client. But it's not quite the same as being able to walk a client through in a face-to-face meeting, an application, and get a wet signature at the end of that meeting to conclude the transaction. So in this regard, we believe this is a delay rather than that there's anything fundamentally wrong. What we are doing as part of this initiative is, if you can't increase the conversion rates currently because of these delays, then we need to work on expanding our intermediary base. So clearly there's an initiative going on there. The other product that I alluded to is really the workplace pensions. In that scenario, we can see that we've got good, solid, steady organic growth. That is as to be expected. You know, we've got circa 4,000 employers that use our master trust. They'll have individual members that leave. Those members become what's called a preserved member. We still get our fees per month on those members. And of course, they'll be replaced by a new employee. So we'll then get our fees per month on those new employee contributions. So organically, our growth is as we'd expect. The frustration really for us is that there's some step change opportunities in the marketplace currently, where you've got books of business with master trusts that didn't go through the authorization process during 2019, and are therefore required to offload those books of business. Typically, they're the 15, 20,000 members master trusts. 20,000 members, to give it a quantum, is round about £400,000 worth of fees per annum. So it's very, very definitely worth having. And what we've seen here is these books of businesses, because of the COVID, the pension regulator is allowing them to take longer to decide where they're going to transfer them across. So again, we are earmarked for a number of these books of business. It's not about decisions not being made. It's about the delay in terms of that process. We're in the process of picking one up currently, which we originally expected to have landed in beginning of the second quarter of this year. So there is a frustration there, and that sort of had the negative impact in terms of my expectations in terms of that first 6 months. Other things that have come through in the first 6 months, which really don't necessarily impact the numbers to date, are our IT projects remain on track. This is massively important to us. We've got a number of large projects on the go which are due for completion at the end of the year, and they will be a significant contributor to our improved profitability, improved operating margins going into 2021. And when you look at the research notes out there in terms of FinCap, that step change in terms of profitability, in terms of margins, is partly taken account of by these IT projects coming to conclusion. Other things in terms of the looking forward in terms of business, we partnered with a fintech company who specialise in Sharia products. They're out of the US, they're backed by Goldman Sachs, and we are their partner of choice for their pension products. So we recently launched a Sharia compliant SIP and a Sharia compliant workplace pension. It's worth mentioning we're also their partner of choice for when they look at the European market for their pension products. So that's incredibly encouraging. On this sort of the timing of this really coincides with our rebranding of the Carey business that we acquired in 2019, and our UK brand is now Options for Your Tomorrow. So over the page, I think probably we've covered off the COVID scenario. I think I covered it on the previous page. Nothing else to add there, is there, Therese, from your point of view?
No, nothing.
No. Okay. Earlier on, I was talking about acquisitions being a key part of our strategy, and that's, I suppose, just been endorsed or confirmed by our announcement in August of our acquisition of the Barclay Burt book. Typically, what we're looking for in terms of acquisitions is something in the region of 2, 3, 4 million in revenue, something small enough that doesn't really attract the attention of our larger peers, and therefore it becomes less of a fight over price. So our sweet spot really is to look at something of that type of revenue. We would look typically to pay up to 2 times revenue. So again, we're not looking at the 4 or 5 times revenue that we've seen in the market from some of the other SIP providers. The key features for us is that recurring revenue theme. So in terms of the SaaS book, in terms of the group pension plans, what they have there within the Barclay Burt book is typically the average life duration these clients have been with the Berkeley Burke is something in the region of 15 years. That, you know, they're not going there, they've had a good service, and we become part of receiving that recurring revenue going forward. In the particular scenario of Berkeley Burke, the group pension plans, they look after a number of blue chip international clients, such as Shangri-La Hotels, Marriott, etc. And they, in terms of those international pension schemes, and that becomes a massive credibility check for us in terms of these blue chip companies as part of our launch of our own international plans from Malta and Gibraltar. So I do see that as very much complementing what we're going to be doing as part of our growth strategy there. And finally, what we expect to receive in terms of that, so we're looking to typically pay, on this particular scenario, 1.4 times revenue. We'll get within, by the time we finish integrating this business, it'll add 600 grand to our bottom line. So you're looking at a 3 to 4 year payback. Again, that's the type of parameters that we will look for other books of business going forward. Teresa will now just start to dig in a bit more into the different divisional stuff.
So in terms of our revenue contribution and split by operating segments, so no surprises, pensions is by far our largest division at 67%, so just under 8 million. And that's obviously because the latest acquisitions have all been on sort of pensions. In terms of life assurance, 16% of our revenue. In terms of sort of headline numbers, that looks like a decrease. That's predominantly as a result of a one-off technical reserve release that we had in last year's numbers, which is no longer included in, the reserve is down to 0, so there's no further releases on that, and there's a separate slide on the life assurance, so we can talk about that a little bit later on. Trust and company management now accounts for 14% of our total revenues, and so a decrease from last year as a result of natural attrition. Again, there's a separate slide on that, so we can discuss that a little bit later. And our other divisions, historically, it's been the Spanish office and a small insurance management office that we used to have in Gibraltar that closed down in March 2019. So that explains the decrease, and the 3% of other is now purely the Spanish offices. In terms of how our recurring revenues are made up, again by operating segments, we can see from this slide that pensions and life assurance by far the highest proportion of recurring revenues, with both of those in the 90s, with companies and trust management down at 38%. CTS is typical, the sort of chargeable work, transactional work, activity-based work, and therefore, whilst recurring by the fact that we typically do the same amount of work sort of year on year, it's certainly not fixed, hence why we do not include them in our recurring revenues. Putting a little bit of background on the divisional segments. So in terms of our pensions numbers, and this slide talks about absolute numbers, so this is how many units we look after. So on the left-hand side, our SIP products, they're administered from the UK. We've got two main products, the UK-facing products and the international SIP. The international SIP clearly targets the non-UK market, so our expats and the international market, but still very much a UK regulated product and administered from the UK. The right-hand box at the top, that's our QROPs, and those are administered from Malta and Gibraltar. And again, the new business run rates, very stable, very much in line with management expectations. And the beauty of these products are that low attrition rate. Even the QROPs are at 5-6%. It's just it demonstrates the stickiness of the segment and of the business. How those numbers relate to our finances is on this slide. So we can see from the QROPs, very stable business at around 5 million, very little one-off fees. And like we keep reiterating, fixed fee-based and therefore very much recurring. In terms of SIP and auto-enrollment, again, the increase from the last year to this year, two reasons. One, this is the first full 6 months of Carey acquisition. We actually completed the acquisition in February of 2019. So last year there were 4.5 months. This year there's the full 6 months, and obviously that sort of organic growth as well reflected in these numbers. In terms of the life assurance, as I was saying earlier, we can clearly see here how the 2 million compared to last year's 2.8 million is made up of, and we can see in the sort of under the grey heading the 0.95 of one-off fee for LCA for last year, and that was the technical reserve that was the last of that technical reserve that was in the balance sheet now being released, and that was as a result of the London and Colonial Assurance Company that we acquired in 2016. It came with a reserve on its balance sheet of 3 million. And as we've been reducing the cost per policy, the actuary has recommended a consistent sort of release year on year until the last of it was released last year. In terms of so the annual fees, again, fairly consistent from compared to last year. And our trust and company division, so we can see here that decrease in fees is in revenue is predominantly from the Jersey business. We were aware of certain customers that wanted to close down their structures just because they sort of met all the requirements and they just weren't needed anymore. And again, closing down the structure takes time and clearly generates revenue whilst it's being closed down. So it is something that management were aware of and have been managing, managing and adjusting costs appropriately.
It's worth probably just touching on acquisitions. As I had mentioned previously, that the PLC board is absolutely supportive of the acquisition strategy. My expectations are that hopefully we'll be updating the market on a reasonable, regular basis in terms of looking at acquisitions. What we are seeing is that having sort of banged the drum saying that we are openly looking for acquisitions, is that there seems to be a number of decent books of business out there for ourselves. I won't go into the specific details of the profiles of the CureOps or the SIP, etc. But needless to say, the theme for us is that there is a strong recurring revenue basis there and a longevity of client base. Typically, as you see, Therese mentioning that CureOps 5% attrition, to me, flipping that the other way around means that a client is going to be there for the next 20 years on average. In terms of summary and outlook, I'm really enthused about the opportunities for us in going into 2021. On our website, under the investor relations section, there is the FinCap research note. They have us, in terms of their expectations, moving us from 2.5 million of PBT this year to 4.5 next year to, I think, a short 6 million, I think 5.9 in 2022. That sounds like a big jump, but when you start to look at what we are putting in place in terms of IT initiatives, where we are moving our operating margin, you look at some of our peers, their operating margins are in the mid-20s. I think Curtis Banks have said that they're targeting an operating margin of 30% in 2022. Again, these are things for us to move towards as well. We have the tools to do that. These projects are all on track and are due to completion towards the end of this year. We've got some new products coming through, as we said, the Sharia side of things, a lot of activity starting in terms of marketing into fourth quarter of this year. We've got some acquisitions to come through, and in addition to this, we've got a couple of books of business in terms of that workplace pensions, that delay for these books that we were looking to receive earlier on in the year. And that will move our auto-enrollment business from a slight loss-making business just about moving into break-even in the next month or so, through to a small but profitable business into 2021. And the model of that then demonstrates the scalability in terms of that hockey stick curve for that particular business. So I'm absolutely enthused at that side of things. From my perspective, it's a very interesting crossroads as to where we are in terms of how we're viewed. And I think we have clearly suffered in terms of rating for various reasons, whether it's because we've been seen to be too international, too overseas. If you look at the FinCap research note, there's a number of comparators there in terms of peers, etc. Probably, I think the two that are closest to us are the likes of the Curtis Banks and the Mattioli Woods of this world. One of my observations that I see, and one of the opportunities I think from an investment point of view, is typically we're just under half their revenue. We're probably somewhere between a third and a quarter of their profit, and we're about an eighth in terms of their market cap. So I think there's opportunities. We need to clearly, as a business, as a management team, we need to deliver on those numbers. We're very confident that is achievable, and hopefully the market will recognise the opportunities in terms of that as a re-rating for us as we move forward. I think that concludes where we stand at the moment. We'll leave the investment case picture up. I don't think there's anything there that wouldn't have already been covered off in terms of our presentation. But if I pass back to you, Tom, as to how you want to play, any questions or anything.
Great, super. All right, thank you, Alan. Thank you, Therese. So, as Alan says, if we can now turn to the questions. We've had a number of questions that were submitted ahead of the presentation, but please do continue to submit via the Q&A tab if you have any questions that spring to mind. I'd just like to remind everybody that the recording of this presentation, along with a copy of the slides and the published Q&A, will be posted to the Investor Meet Company site and will be available for inspection after this presentation. Now, when looking at a number of the questions, there are a few that we have actually covered quite comprehensively in the presentation itself. So I don't propose that we go back and cover those. There were quite a few around acquisitions, which, Alan, you've covered quite comprehensively. So for those who asked the questions about whether you have a specific, what you look for in an acquisition target and whether you have an acquisition model, I think we've pretty much covered those. So we won't cover those again. But one that I guess will be of interest is a question in and around to what extent COVID is holding up the acquisition process. I wonder if you might just comment on that quickly, Alan.
Yeah, it's a good question. I think it's fair to say that had COVID not come along, we would have probably been announcing the Barclay Burke acquisition in about April of this year. The fact that COVID was there delayed the final signing, the SPA. Turns out you can do huge amounts of due diligence online rather than have face-to-face meetings, but never quite the same. But it probably added 3 to 4 months in terms of that delay. And certainly the other acquisition that we have on the go as we move forward has probably suffered from a similar level of time delay as a result.
But is it fair?
What changed, interestingly, is the number of information memorandums that come across our desk. If anything, and they've probably gone up a notch. I think it's probably where people have been, particularly owner-managed businesses, where the individual probably getting towards retirement age, which is exactly the Barclay Burke scenario, or in his case, actually past the retirement age, sitting at home and thinking, actually, isn't it time I sold my business? I've run it for X number of years, and it's time to take his retirement pot. So I think we'll continue to see just as many information memorandums, if not more, than pre-COVID.
Okay, so all right, so no real let up in the flow of opportunities. Can we just look at a couple of slightly more financially biased ones? So one question here we have on Ebitda margins. Ebitda margins appear lower than your peers. Is there upside here?
Yes, there is. As a result of we're investing quite heavily in our IT projects, and that will no doubt increase our margins, EBITDA and PBT margins going forward. So as Alan was explaining earlier, the FinCap research note has got our PBT margins increasing from what they are this year to 15% next year and 20% the year thereafter. And that's as a result of both cost savings in terms of license fees on IT, as well as efficiencies, operating efficiencies, and the fact that obviously it will become a much more scalable business following that investment in IT, which is also sort of flagged up in our investment case slide that we've got on our screens right now.
Yeah. And to add to that, I see that as the opportunity and the challenge to move towards those margins, and I have no doubt that we will achieve similar margins to our peers in reasonably short order, given the IT strategy we have.
Great. Okay. But one more slightly industry biased question here. How do you see revenue to asset under administration trends? Most investment managers appear under pressure.
Most of our fees are fixed fees, so they're not based on our assets under management. So we don't actually see much of an impact on our revenue and our financial performance as a result of that.
Okay, super. All right. A couple around regulatory capital. So the first question here is about the requirements of regulatory capital, and in fact I'll just point that person to slide 20 if I could, because there's a relatively detailed slide that will be part of the slide set. But there was an additional question as to what regulatory and tax policy risks are within the business.
So yeah, you're absolutely right, Tom. Slide 20, which is included in the appendix, that has a lot of information that splits out all of our products by jurisdiction. It shows the size of each subsidiary. It also discloses obviously the regulator and our solvency requirements. In terms of our regulatory requirements, obviously we have to abide by each jurisdiction. Each one has got its own sort of peculiarities as to how regulatory capital is determined, is defined. For instance, there are some where your deferred income is recognized as not being a true liability, even though it sits on the liability in the balance sheet, and therefore you're allowed to add that back. Other jurisdictions don't. So it's quite a complex exercise that is done by each of our subsidiaries.
Probably if I take the regulatory or tax policy risks, as a rule, we don't give any tax advice. In fact, we don't give any investment advice, and we're not regulated to do so. So our products are very much standard products per se. So the tax risks I see as minimal within the business. I think, given the world of financial services and given the sort of the increase in litigation, I think it's fair to say that there is always an element of regulatory risk. I think you see that particularly in the UK market with the pensions industry, and there's a couple of significant cases out there. There's bizarrely there's the Barclay Burke case, but that's to do with the SIP business, nothing to do with what the acquisitions we did, and also the ruling in favour of Carey in the Carey Adams case, which basically says that SIP providers should not be responsible for the investment decisions and performance chosen by their financial advisors or the members themselves. But there is that, clearly there is always that regulatory risk in terms of the overall industry. I don't think we are as such are any higher risk from a regulatory perspective than any other of our peers out there.
Great. Okay, super. Thank you. So probably the final question for this session. Are there new areas of financial services that you would look to expand into?
It's a good question. I think from our point of view, never say never. Clearly, we are moving forward, and our vision as it stands today is very much on the pension administration and also the life wrappers, those portfolio bonds we talk about. I think we're fortunate enough that we have, which again is a differentiator in the market. We deal equally as much in the expat market as we do in the UK market, and there's not many pension administrators that actually have both segments of the industry. I can see opportunities to look at products that are complementary to that in terms of, and arguably the flexible annuity is an alternative to a SIP. So I think we would look to to broaden our base. You know, let's talk about, should we have, if you've got offering a simple pension in terms of a simple SIP, a platform SIP, should you also offer an ISA? And arguably, if we're doing a Sharia compliant SIP, could we do a Sharia compliant ISA? So I think looking at it as horizontal expansion, I do think there's going to be continually new products that we will offer to the market. We wouldn't roll out vertical integration, and there is an argument that that's occurring in the market already. I think we've got to make sure that whatever we acquire is complementary to the business as a whole, rather than becoming more of a standalone acquisition.
Great. Okay, super. All right. Well, I think that's a good place to round it off. We're coming up to the hour. So thank you, Alan. Thank you, Therese. Could I just ask investors not to close this session just yet? Feedback is very important to the company. And if you've accessed this meeting from the website, the feedback page will appear. If you've accessed it from a link via email, you'll be asked just to log in to submit. But if you could do that, that would be much appreciated. If anyone has any further questions or would like any additional information on STM, please do contact stm@walbrookpr.com, and we'll obviously endeavour to help you out. But many thanks for attending today's presentation, and we hope to see you again.
Indeed. Thank you very much on behalf of Therese and myself for taking the time to listen to our presentation. Thank you.